This is brought to you by John Daniel and Partners LLP.
So thank you so much for joining today's webinar. As I said, we are going to start by 10:10, and it's now 10 minutes past 10. So I'd like us to start. Our topic today is benefits of financial planning for SMEs in 2024. I think it's good for us as SMEs to financially plan for this year before it starts, so that we are able to know our finances and be able to manage them well. So our speaker today is going to be Chris. Chris is one of us. He'll be taking us through the topic for the next maybe 1 hour. So I would remind us that we are able to use our chat box area where we can put our comments. If we are not audible, please let us know. If the speaker is not audible, please you can share that through the chat box, or you can raise your hand and unmute so that you're able to know and rectify. So welcome so much. My name is Mercy. I'll be meeting you in the next few minutes after the presentation. So thank you. Chris, if you can hear me, please unmute yourself and start our presentation.
Thank you, Mercy. I hope everyone can hear me. You can confirm, Mercy, whether I'm audible.
Yes, Chris, you're audible.
Okay. Today I'll be taking you through. Welcome once again, the members who have joined us. I will be Hello, members. Kindly, there's someone who has not muted. Yeah, I think that's good now. I'll be taking you through the financial planning bit of the business. As you all know, financial planning is very essential for businesses. It really comes at a good time at the start of the year, so that you can be able, as a business person, hopefully many of you are representing businesses, to have a way that you can manage your resources, the financial resources that you have as a business, to make most out of those particular financial resources, and have a good state or some good health of your financial operations within the business as at the end of the year. So I'll be taking you through why we would want as a business to have financial planning, and the details that are involved in making such a financial plan, and why you would consider doing the financial planning for your business. I hope this is clear now. Yeah, when you're saying financial planning, there's that bit of financial. This will involve basically all the resources that are tied to finance, and we'll be looking at areas such as revenue, also the expenditure part of the business. You'll also be looking at investments, savings. You'll also want to look at the profit margins in terms of the business. So that's why we are calling it a financial plan. And those areas will be covered inside the financial plan. Basically, for that particular, we are not going into such areas such as human resource or other areas, but we specifically restrict ourselves to the financial part of the business, which will involve the revenue, the expenditures, the savings, investments, profit margins, towards that particular direction. From my picture, you can see you'll have some money money involved. You'll have some analytics, basically to know how the revenues are shifting or the profits are shifting, how much of expenditure you are getting. You also have some calculations to calculate if you want to do some budgeting or forecasts. You also make some graphicals about your data in terms of revenue. So all those particular areas will be involved in the financial planning. As a definition, I will simply define it in 3 steps. One is a process. So it has some particular steps for you to achieve it. It's not a one-time thing. So it's a progressive process where you'll be setting and achieving setting up organizational financial goals and seeing ways that you can achieve those particular financial goals. But then as you do the process, there are some 3 steps that I saw that will be very valuable. One will be the assessing the current financial status. As you set up the financial goals, you need to assess your current financial health. This is in terms of how much revenue you are earning, how much of expenses that you are incurring as a business, how much profit is the business earning, how much returns are you getting from your investment from the business. You also want to determine the future financial needs. What do you want to aim to get in terms of finance after a particular period of time? Would you want to increase your revenues? Would you want to bring in new products into the market? Would you want to borrow or have debt into your business? Would you want to up your profit margins after a particular certain period of time? Then once you have those, then you need to have a roadmap. Basically, these are steps and something that a guideline that will help you reach these particular goals. So by definition, I think that encompasses all the areas that would be captured under the financial planning. There are some elements that I would want us to look at if you are doing financial planning. One is setting goals is very crucial. As we said in our definition, once you assess the current financial status, and this is towards setting and achieving organizational financial goals, then one of the elements of financial planning, which is very key, would be setting up goals for your business. And they must be financial in nature for this particular case, because we are only restricting ourselves to the finance part of the business. You'll have to identify them. This is you as the owner of the business or in charge of finance of the particular business. Identify them, whether they'll be short-term or medium-term or long-term. So you have to take note of them. Then they'll also have to be smart. Smart, we mean they should be specific, measurable, attainable, relevant to the business, and also time-bound. We'll see this as we progress, how we can make them smart. Another key element would be analysis. You need to assess your current financial situation. By saying this, you are assessing your current financial health of the business. This will involve how much revenues you are basically dissecting the financial side of the business. This would involve knowing how much revenue you are earning, which are your streams of income for that particular business, how much expenses are you incurring as a business, the particular lines of expenses that you're incurring, what kind of expenses are you incurring as a business? Are they step expenses? Are they variable expenses? Are they fixed costs? All those. You also need to know how much of cost of goods are you incurring as a business to give that particular service to the clients or offer that particular product to the market. You also want to know how much return are you getting from this particular business. You'll also want to know how much profit you are making as a business. Are you making a profit? Are you making a loss? And how much of that particular loss of profit are you having as a business? So that's why we are saying you have a deep analysis of your financials of the business for a particular period of time. This analysis will also help us forecast, make budgets, because you cannot make a budget without an analysis part of it to see the trends in the expenditures, the trends in revenues, the trends in returns, so that will make informed decisions on those based on those particular analysis. We'll also have forecasting and planning. Forecasting, this is having futuristic expectations of the business. You can forecast revenues, you can forecast expenditures, you can forecast business returns, you can forecast profit margins. With the forecasting, we can use simple budgets and cash flows, basically to know the state of your cash as at the end of a particular period, or have budgets that will guide you on your spending, on your revenue, so that you track them and see whether you are hitting your targets over a specified period of time. You also need to have a risk analysis. You identifying the potential risks within the business. This will involve a lot. You have to sit down and analyze keenly what is really affecting your business and why your business would be jeopardized in terms of achieving your financial goals. So all those areas should be noted down and taken note of. You need to create an action plan. Now, how are you going to get to these particular financial goals? What will you use? How much resources will you employ to get to these particular goals, to achieve these particular goals? You now incorporate other areas like human resource. Do you need capital? Do you need more staff? Do you need more products into the business? Do you need to increase your prices? Do you need to lower your expenses? So come up with something, a guideline on how now you are supposed to achieve those particular financial goals. Once we've done that, once you have the action plan, then now you can do a tracking of progress to see how much are you hitting your targets. If you said this goal should be attained by the first quarter of the year, are you able to reach for that particular target, or do you need to make an adjustment? Maybe some you may be faced by some external factors that may hinder you from achieving those particular goals in time. So you need to make the necessary adjustments. You also need, if you had set a lower target, you can set a higher target. If you had set a higher target and you see that it's not achievable, you can set a lower target based on the action plan now. So that now you can, so this will be afterwards, after you've created everything, you can now track the progress, see how you are progressing, and make any necessary adjustments to everything, to the items in the financial plan. I think we can go deeper into these particular elements so that we can see what each element carries on and how you can navigate it. On the SMART goals, remember, you need to start with goals. You need to identify goals that you need to achieve as a business. Now, those goals should be financial. Do you want to have huge returns in terms of your investments into the business? Do you want to increase your revenues? Do you want to increase your profits? What do you want to do with your business? So you must have all those particular goals. Do you want to lower some costs? Do you want to get new products into the market? Or do you want to take away some products out of the market that are non-performing? So you need to start on a place where you know what you want to achieve after a particular period of time. Now, the goals that you are targeting, they should be SMART. once we say smart, we are saying that they should be specific. They should be relatable to something that's not ambiguous. You can be able to know what this goal is saying. In short, once you see it, if you are noting it down. So it should be specific. By specific, you need to mention what you want to achieve, when you want to achieve that particular goal, and how is it affecting your business. If you are saying it's measurable, you should be able to measure it. How will you know that you have achieved that particular goal? So you must set a goal that can be measured. Should also be attainable. You don't have to put something that have a goal that you cannot attain as a business. It should be realistic. It should be within your resources that you have, so that now it can be attainable. It should also be relevant. By relevant, we are saying, is it touching on finance part of the business? Is it relatable to your objectives of the business? Then should be time bound. You should have a maximum time that you attach to that particular goal to attain it. So I have two goals here. There's A and B. I would want, before we even, so that we can come back to them, you can notify me in the chat section which of the two is a smart goal based on what we've seen smart goals are. I'll be glad to get your feedback on the chat section about the smart goals. You can also have, we can also have your smart goals there. If you have one smart goal, you can have it there, then you can have a review of it and see whether it's smart. Because it's from these particular goals, then now you can do a financial plan based on the goals. In the area of analyzing the business financial health, there's one framework that's called MED. MED is a short form of measure, analyze, and decide. Framework that you can use as a business to see how you are performing in terms of financial aspects. The measure will be, you are measuring the business financial performance and the economic conditions surrounding the particular business. By measuring, that's where now you will have analysis of how you've performed as a business in financial statements. You can have the income and expenditure account that will show you how much you've earned as a business, how much of expenses you have as a business, and then how much of profit are you having as a business at that particular time. You can also have the balance sheet. The balance sheet will show you how much assets you have, liabilities that you have, and how much of net assets, the worth of the business you have at that particular time. So measuring will involve quantifying the performance of the business at a particular time. At the measures section, we want to know how much revenue you've earned for any particular period you are considering, how much expenses you've incurred as a business, how much is a profit, how much is the rate of return for your investment into that particular business. We'd also want to see the profit margins of that particular business, and no, that's a financial performance part of the business. We'd want to see the economic conditions. Is there inflation that is related to those particular products that you are taking? How is the market responding to the particular products that you have in the market of services? So all those factors combined will give you a measure of the business performance at any particular time. You may also you may need to employ financial statements because they'll give you a true value of the financial performance of measurements at any particular time. On analyzing, because you already measured this particular data that is related to financial performance, you need to analyze that particular data But analyzing, you'll be looking for the trends. Is your revenue going up? Is your revenue going down? Are there some months that your revenue short? Are there some months that your revenue went under than what you expected? We'll be looking at are your expenses shooting? What kind of expenses are actually shooting up, or which expenses are going down? What kind of expenses are you incurring as a business? We'll also be looking at your profitability. Is your profitability gaining or losing? Are you towards a loss or are you towards a profit for that particular business? How is your return? Is your return negative or is your return positive? Is it more related to your industry? So all those particular trends, you'll be able to look at them. Then you'll be determining the source of financial outcomes. What caused these particular outcomes? If your profitability is going down, what is causing that profitability to go down? If your profitability is gaining, what is causing that particular profitability to gain? If your revenues went under, we want to see why your revenues are actually going down. If your expenses are increasing, we want to see why your expenses are increasing or decreasing. So those particular source of financial outcomes, we are now saying what you measure the financial performance. Why is it behaving the way it is behaving? Because from that, you can be able to get the insights on what is going right or on what is going wrong. Then you'll also to understand the unit economics. How much are you making per particular unit of product or per particular service? So you'd want to break it down and see how much costs are attributed to a particular product, or how much profit are you expecting to gain from a particular product, or the same will be applied to how much are you selling a particular product or a service versus what you are using as an expense to generate that particular service or a product. I would want to go back just a little bit on the measure side. On the measure side, you'll also be wanting to look at what are your sources of the revenue. You want to see what if you have several line units of revenue. Let's say you have different products, you have product A, B, and C. You'd want to see how much each product is performing, depending on what you have on the financial statements. You'd want to see how many revenue streams you have in terms of a business. If you are doing services at the same time doing goods, you want to see why the goods section is performing the way it is, like how the revenues are coming in terms of selling the goods, or you have a service, an alternative of a service, or you have different products. You want to see why this particular product is performing better than another product, or why that other product is performing poorly related to the other products. So in the analysis part, we also have the interpretation of the financial performance. After now you've known the outcomes of that particular analysis, we would want to see now how you interpret that particular financial information. In the interpretation, then now you'll be able to see if your rate of return is decreasing, then now what does that mean to that particular business? If your revenue are increasing, what does it mean now to the business? We'll also have assessing strategic successes, failures, and raising questions. What are the opportunities that you have to bring success to that particular business? By bringing success will be maybe increasing the profits, shifting it from a loss to a profit, decreasing your expenses. So we want to see the strategic plans that you have to have successful revolution of the business. We also to see why the failures. Why are you failing in a particular section, or why a particular product is failing? Why is our service not delivering the revenues that we had projected? Why are you on a loss rather than being on a profit? So all those areas. So in the analysis part, we'll ask so many questions rotating to the business, because it's from the questions, then now you can make strategic solutions to those particular problems that are facing the business, or you can come up with ways that you can retain a particular revenue or increase even further the revenues. We have a decision at the end, so the D is for decide. These were now after measuring the financial performance and doing deep analysis of the financials that you have. Then now you make informed decisions based on the interpretation, based on the analysis, and based on the measurement of the financial performance. So you say if one product is performing poorly than we expected in the market, then now you can make a decision as the owner of the business. Then say we either pull that particular product from the market, or we have other ways that we can make sure that particular product is gaining into the market. We also want to make decisions on profits. If you are on a loss, you do want to cut your costs so that you come all the way from a loss to a profit side of it. If your revenues are not performing as expected, what would you employ to actually increase those particular revenues? You have to come up with solutions, not on the decision making. Come up with solutions. If you want to push a particular product for it to perform in the market, come with a solution that will help you do that. If you want to increase the revenues, come up with a solution that will help you increase the revenues. If you want to lower your costs, come up with a solution that will be aimed at lowering your costs. Then you can also capitalize on opportunities that arise for a business. There may be other opportunities outside your business, maybe new target markets that you haven't explored as a market. That's an opportunity. You have a product that you can push into the market and it can move really quick and make good gains for the business. That's an opportunity for you. So look for those opportunities that you have foregone, that you are not capitalizing on, and build on those particular opportunities. If you have a success, let's say a particular product is bringing in good revenues, then now you can build on that particular product and even revamp the revenues further. You want to communicate the financial implication and the growth strategy. As owner of the business or as a finance person, then you should be able to communicate this to the owners of the business or to your employees on the financial implications that are related to this particular financial performance of the business. You have to come up with a growth strategy and say it out to your employees so that you incorporate everyone, and the business owners, you incorporate everyone, so that now you can have one goal that you're all aiming at, and everyone can have their input into that particular strategy to revolutionize your business. I have some steps here which can get you on the analysis part of it. So you'll need to understand your sources of revenue and revenue growth. Why, what brings in revenue to your business? For example, if you are trading on goods, then you'll identify those products that you are selling that bring revenue to the business. You also want to understand why is the revenue growing or dropping. So if you have a negative growth in revenue, you'd want to understand what is going wrong in that particular revenue. Is the product not being liked by the market? or are you not having enough efforts to push that particular product into the market? Are you delivering your services poorly? That's why they are not bringing in the revenues that you targeted. So this is analysis of the causes of the changes in revenue, and also the sources of the revenue. If you are doing a service, what kind of services do you offer that bring in the revenue? Because it's from understanding these particular services that you can now come up with good steps and also good growth strategies that can enable your business to stay afloat. So the other thing you need to do is to understand the costs and margins. You want to understand what costs are related to your business. Do you have fixed costs like rent? Do you have, how much are you paying your employees? How much are you incurring as cost of goods? How much are you incurring to print or have office equipment and all? Every cost, you have to understand what cost, what kind of costs you are incurring as a business, and also their margins. You also want to understand the profitability. Where are you in terms of profitability? How much? So you also want to ask yourself, is the business profitable? And then you can be able to make informed decisions about your business. You also want to look at the rate of return. The rate of return is, sometimes you have negative rates of return. If you have losses, you can have, means that the capital, you are not employing enough of resources to capitalize. You also want to understand working capital and operating cash flows. How are you able to pay your liabilities? Basically, these are outstanding. What the customers or the business. So you don't want, or are you able to even have effective cash flows? Basically, knowing the cash at any particular point of time, that will be very crucial, so that you don't find yourself in an environment where you are defaulting on credits. You also want to know if are you capable of paying any interest that come with the loan, and also the principal amounts, all that incorporated. You also want to understand your lines of business data. Basically, this is knowing your lines of revenue, your lines of costs, what costs you have as a business, what sources of revenue you have as a business. All that particular will form now the analysis part of it. Then now you'll have a very expounded view of the business. We also have some parts that can really help you in planning. That's one, the budgets. The budgets, these are estimates of business income and expenses over a period of consideration. So you want to estimate how much your business will earn for a particular period of time, how much you will gain from maybe each particular product. If you want to diversify further, you want to see how much expenses you expect to incur over a specific period of time. This will enable you to always compare what the actuals that you have for a specific period of time versus what you had budgeted, to see whether you've surpassed your budgeted revenues, or are you limiting on your expenses so that you don't surpass what you had budgeted for. So the budget will help you guide on how you can spend for any particular expense. And also it will help you, it will also guide you on to know whether you are overspending already in terms of expenses, or have you surpassed your targets in terms of revenues, or are your revenues underperforming. So how do you set up a budget? One is you first set clear goals. You can see setup of goals is very crucial for every step. You'll define your financial goals. What do you want to achieve after a particular period of time? They can be short term or long term, depending on how you want them to be. You can set one goal like if you want to earn 1 million in a month, that will become part of the short term. But if you want a long term one, can be you want to get to a particular point of revenue over a period of 2 years, 3 years, up to 5 years. You also want to gather relevant financial information. You want to know this part will involve knowing your business better. What are the sources of income? How do you spend? What are the expenses that your business incurs? You want to do some tracking of the spending and income to know how much you are spending, how much you are earning. This will be helpful. This analysis will be helpful to project what will be earning in the future or what will be spending in the future. So from the tracking and spending, you can have trends. Is your revenue increasing by 10% at every particular month? Or is your revenue growing by 1% over 4-month periods? Are your expenses dropping by 1% or are they increasing by 5%? So we just want to see the trends so that the trends can help us budget or forecast what will be happening in the future. Then the next step after knowing all those, you create a budget now. This will be based on your financial goals. So remember, you at the beginning you set up the financial goals, and you already know how much you spend and what you expect to spend for any particular expense that you are incurring. Then now you'll create a budget whereby you'll be allocating the revenues, you'll be allocating each expense category. It's very crucial to know that while setting up the budget, you need to start with the most essential expenses towards the more discretionary ones. You want to see the most important ones like cost of goods. The cost of goods is what makes up the product or good that you are selling. You may want to invest on those first before you even pay your rent. So those are issues that you can see which are most important expenses that without them you cannot run the business towards the less important ones. Then you'll have your budget. We'll see the budget later. So you can also have some events after the budgeting process, because budgeting is not the end, it's a process. It's not a one-time thing. You'll need to monitor and do some readjustments on the budget. You may note that due to some other factors, your revenues are overly increasing than you estimated. So you may need to do some adjustments, but for you to know, you need to be monitoring that particular budget. By monitoring, you are comparing the actual versus what you had budgeted for any particular month. You can do it on a monthly basis. If that's a procedure that your business will be doing. So after the monitoring, you'll be able to know you may have understated the particular revenues, so you may want to readjust them or revalue them upwards. You can also have some expenses that you overstated and you want to revalue them downwards, so that's very possible. Or you understated some expenses while you foresee that you'll incur a lot of expenses for a particular expense head. So you can do such adjustments after doing the monitoring. There's also the review and revision. You need to review the budgets periodically. This will be at your discretion. You can do it monthly or a quarter period or semi-annually. And see whether there are any changes, see whether you need to adjust your financial goals or whether you need to adjust anything in from the budget. You can also seek professional advice if you are not sure or if the process is complex for you. It's always advisable to seek professional advice so that they'll give you insights on how you can do it well, and so that the budgeting can be of help to you and the business. I have an example of a budget here, which is from my company, XYZ Limited. So this is an example. So you can have your revenues. Where are you? Mine is a clothing line business. So I do retailing of clothes. I also rent gowns. So I estimated my revenues in January to be 20%, to be 20,000, and the rentals from gowns to be 15,000. So these are just projections of what I expect for each particular month. And I've done it for a semi-annual basis. On a semi-annual basis, then I have versus my expenses. I can be able to track how much profit I expect to gain till June. So this is the beauty of doing the budget. You'll be able now to compare this against the actual. So in January, I'll just look at my sales and see how much I sold compared to what I projected, or how much of expenses am I incurring compared to what I had budgeted here. So why is it important to do financial planning? One, this will enable you to do strategic decision making. Remember, for you to do any decision making, it has to be strategic. My meaning strategic, it has to be relevant to your goals as a business. So you may want to do all the decision makings that will touch or that will help you achieve those particular goals. That's why it has to be strategic. So from the financial planning, you're able to get data-driven insights from all the analysis that we've seen, from the measurements, from all the steps that we've seen towards a financial planning. You'll be able to get data or insights from the data, from interpretation of the data, that will help you now do decisions that will be key in attaining a particular goal that you want. So another one is you'll be able to control your expenses and also be able to know your revenues, how much you expect to earn. So if you do budgets, so budgets still under financial planning, you're able to monitor and control your expenses so that you don't overspend at any particular time. And this will also be able to know how much you expect of revenue and profits. You'll also be able to do some cash flows and see how much cash you have at any particular time, so that you make any decision making based on those particular insights that you have from the financial plan. It's also a tool of financial measurement. You'll be able, during the financial planning, you can establish key performance indicators and metrics, whereby you can be able to track your business financial performance. If you want to do to know how much you expect to earn in terms of profits, your KPI could be profits to see whether your business is growing or not. So those particular key performance indicators, such as profit or revenues or rate of returns, are good metrics to help you track how you are performing as a business. It will also bring new skills to you, such as cash flow management. Remember, for any business, you need a cash flow management. This is basically knowing how much cash you have at any particular point of time. You can be able to know how much you are supposed to pay, how much of more products are you supposed to pump into the market, so that you attain a particular cash flow status, so that you sort your bills in time. You'll also be knowing how, with the cash flow management, you can project how much you expect to earn versus what will be spending, and the cash that will remain, how you can invest that particular cash. It will also help you in risk management, because the risk management is a step in doing the financial planning. Then you can be able to know what risks your business faces and how you can mitigate those particular risks, so that you'll have this information up hand, so that you make informed now the decisions on the risks and the ways that you can do to actually have such particular risks that are related to your business eliminated. You can also have the investment decision based on financial planning. You'll be able to know how much you are supposed to are you going to pump more capital into the business? If the business has some good rate of return, then you can consider pumping more capital so that you earn more from that particular business. If your business is not performing, then you may look for ways such as debt so that you can be able to stay afloat, or not invest your own capital into the business. There's also resource optimization, whereby you'll be eliminating any wastes, any inefficiency in the business operations. Even for the budgeting, you can allocate the resources for the maximum benefit of the business, so that you don't have resources that are lying, you don't have the cash that is lying, and you don't know what to do with that particular cash. So you can be able to optimize those particular funds, to have something. You can ever develop more products. You can even do small sales and marketing, so that now you push more the revenues up and up. You also want to see if your assets are just lying. If you have a bakery and your oven is just is not generating enough, or it's under capacity in terms of production, then you may be, from the financial planning, you'll be able to know if you are underperforming in terms of the quantity that you can supply into the market. Good. I think that's the end of my presentation. I would want to go back to my question on the SMART goals and see what you have, because I had asked to see which of the two is a SMART goal. I can see it's only one who has responded. It will be good if I see some more people responding, because we cannot mark one. Good. I can see the participants have answered, and most of you are saying B. Okay, we can just subject it to the criteria of being smart. So we are just looking at these two particular goals. Which one is specific? The second one is specific because you have what is being affected is the revenue. How is it increasing by 20%? And it's also time bound by 6 months. Is it measurable? A is not measurable because we don't have any metric for the company. B is measurable because we have 20%. So we'll measure it if we'll know that we've achieved that particular goal if there's an extra 20% of the previous revenues that we had. Is it attainable? 20% is attainable for my particular case here. Is it relevant? I assume I had my own financial goals, maybe to achieve a certain particular amount of revenue by the end of the year. So it should be relevant to that particular goal. Is it time bound? It's time bound because we have 6 months. So I should consider my goal within the next 6 months, then I'll measure it against the actuals that I have. I'll invite any questions or any area of clarity that you need me to clarify on? I think at this point, I'll invite Mercy to just take it up. Hello,
Okay.
Mercy.
Yes. Yes, Chris, thank you so much for such a wonderful presentation. I'm sure we have learned a lot from Chris's presentation on financial planning, and I'm sure that our businesses are going to be are well budgeted for or planned for in this year, and we're going to make profits. One thing that I've captured towards the end of the presentation is Chris's budget for the next 6 months for his fabric business. So if all of us as SMEs could have something like that, a business budget that you are able to project your revenue, you're able to project the expenses that you're likely to incur, and then you're able to know by the end of that month or by the end of that year the amount of income that you would have generated. This is good because it's going to help us benchmark, see if we are achieving our goals. Because I know as business people, we had our budgets or we had our plans for the year on what to expect or what to get by the end of the year. I know some of us maybe are planning for a week or maybe a month. Most important thing is ensure that your budget or your plan is smart, as Chris has told us. Yeah. So thank you so much for everyone who has joined. I can see a question which I will read loudly to Chris, and then Chris will be able to get back and answer. The question is from Shedrack Gioshe. The question asks, how does finance interrelate with company strategy? How does finance interrelate with company strategy? This is a very good question, also for us that are in businesses, because as a business, you need a strategic plan, and in the strategic plan, there is finance. So I would like to hear from Chris on the answer to that question. Yeah, and hope that Shedrack is going to be answered. If Chris
Thank you,
can
Mercy.
hear me, you can unmute.
Thank you, Mercy and Shadrach, for the question. I think I'll answer it in a simple term. The company strategy, I think you meant the overall strategic plan of the company. But remember, in the overall strategic plan of the company, it touches on all departments. But there's that particular area where it will touch on the finance part. I think that's what you said by how finance interrelates to the company strategy. So in the strategy, you'll have strategic plan for the finance part of that particular business. So in the finance plan, you'll have now what you call the goals, objectives that you want to achieve and how you're going to achieve them, the financial goals and the financial objectives that you want to achieve, and then you'll have now ways on how you can achieve those particular goals. So finance will be part of the overall strategic plan. But now, if it comes the strategic plan, if we narrow down to the finance related part, then it will have the specific now items that are related to the finance department.
Yes, thank you, Chris. I hope Shadrach has been answered on that question. If Shadrach, that is clear, you can put that comment in the section so that we know. if yes, will finance lead in terms of strategy? Will finance lead in terms of strategy?
I'm not sure what you meant, Shedrack, by saying if finance will lead, but from my comment previously, if you can have a strategic plan uh, for the finance department, but you can also have an overall strategic plan for the overall
This is brought to you by John Daniel and Partners LLP.